Hey, it's Robert Weinberg, and on this channel we empower people to take control of their futures through expert mortgage and financial strategies. In this full video lesson today, I'm going to talk with you about occupancy types when you're buying a home. So occupancy types really come down to what is the use of the property going to be? And you're going to need to determine when you're applying for a loan, is it going to be a primary residence, a secondary residence, or an investment property? It's not as clean cut as it sounds, and you'll understand that here in a minute as we go through this. So let me break it down for you. First of all, primary residence or principal residence is a property the borrower occupies as their primary home. There are certain circumstances, though, where you may be a borrower on a primary residence mortgage and you are not living in the home as your primary. Let me explain this to you. So first of all, if there's multiple borrowers, so it's you and somebody else, maybe even 3 or 4 people applying for a mortgage, only one borrower needs to occupy and take title of the property in order for it to be determined as a primary residence. So if you have 3 people applying for a loan and only one of them is going to live there, that's okay. It can still be treated as a primary residence. That's the first scenario. The second one is, a lot of people don't realize this, but if you're buying a home for your child, okay, you can provide housing for your disabled or handicapped adult child. If your child is unable to work or does not have sufficient income to qualify for a loan on their own, then the parent or legal guardian is considered the owner-occupant. So this can be a huge scenario to allow you to buy a home for maybe a college student or a disabled child or handicapped child, or just a child you have that doesn't make enough money to afford it on their own. You can still get those preferential terms that you get on a primary or principal residence. And last but not least on this is if you're a child that wants to provide a house for your parents, and this is actually a scenario I have right now with a client where their parents came to the U.S. from overseas just a few years ago. They don't make a lot of money at all, and their child here, my client, owns several properties, and they live in one of his properties. Now he's refinancing that property, and we are doing it as a principal or primary residence where he's getting the best interest rate, the best loan terms because it's a primary home. Even though he doesn't live there, his parents live there. So there is some extra documentation requirements with these scenarios where you're providing housing for an adult child or for your parents, but overall, it is a pretty simple process. You just have to have a loan originator that understands these guidelines when it comes to principal residence. And just to reiterate, the reason that you'd want to have a principal residence and have your loan underwritten as a principal residence is because that's going to give you the lowest down payment options, the lowest mortgage insurance options if you have PMI on the loan, as well as the best interest rates, okay? Because these are the lowest risk loans of any of the different types available. Now, the next type of occupancy I want to talk to you guys about is second home properties. Now, second home is going to be a home that you occupy for some portion of the year. So it could be like a vacation home or that sort of thing. But it must be suitable for year-round occupancy. So most commonly, this is going to be like a vacation home or a resort property, in a resort area, that sort of thing. Now, it is restricted to 1 unit dwelling, so you cannot have like a 2-family or a 3-family property that's considered a second home. It has to be a 1 unit dwelling, and that does also include a condominium as well. You cannot have a rental arrangement or a timeshare arrangement. That's not allowed, and there cannot be any agreements that give management control over the property where they can rent it out like a hotel or a hospitality company, that sort of thing. Now, second homes also have very preferential loan terms. The interest rates are typically going to be very close, if not the same, as a primary home. You do usually have to put a little bit of a bigger down payment on a second home versus a primary home, so just keep that in mind. And the last occupancy type here is going to be investment properties. And an investment property is one that's owned but not occupied at any time by the borrower. So this is going to be your typical rental property. A single-family home, a duplex, triplex, up to 4-unit property that you rent out for rental income and you don't live in at any time of the year. That's an investment property. Just your classic scenario for a real estate investor where you're buying a property and you're renting it out. These are great loans, great programs, but at the same time, understand, as I've talked about in some of my other lessons, you're going to need to have a higher down payment when you're buying a rental property. Typically anywhere from 10 to 25% down, minimum, okay? So definitely higher barrier to entry with investment property. And that depends on the property type, your credit score, etc. The other thing is the interest rate on investment properties are much higher than these other types of loans, second homes and principal or primary homes. The reason is because of risk. An investment property is a home that you're renting out. What if the tenants don't pay you? Then there's a high risk that that mortgage will be defaulted. In the housing crisis many years ago, the first loans that got defaulted on were investment property loans. So to compensate the mortgage investor for that risk, they're going to charge you a higher interest rate. And it could be anywhere from 1 to 2% higher typically than an owner-occupied property. So be ready for that. But as a real estate investor, you want to look at the return on investment like we've talked about in other lessons. If you're going to pay 4% on an investment property mortgage, but you're going to get a 6% cash-on-cash return, then it's a good use of your money. It's a good arbitrage where you're borrowing at one rate and you're getting a higher return. Exactly how you can become wealthy. Now, all these guidelines that I'm talking to you about here today, these are right off the Fannie Mae Selling Guide. So these are right from the horse's mouth, so to speak, and this was updated just a few weeks ago on October 7th. You will want to work with a loan officer that is very fluent in these occupancy guidelines because they're not always clean cut. Sometimes you need to show the underwriter these guidelines so that they understand what you're trying to do and how it will fit in the box, so to speak, of any of these scenarios that we've discussed. So I hope this has been of value here today. I hope that you've understood now some new things about mortgage guidelines and occupancy types that you didn't before you actually watch this video. If it's your first time watching, please go ahead, hit the subscribe button and also hit the bell so you get notified on all of our future content. And if I can be of assistance to you or anyone that you know, I am licensed as a mortgage loan officer in the states of Connecticut, Massachusetts, and Florida. And if I'm not licensed in your area, I have colleagues all over the country that I can refer you to help out. So again, thanks for watching. Hope it helps, and we'll talk to you soon. Take care.